guys. Sorry, people are coming in, but I wanted to get started. You're here, Advaith is here. So I don't know whether you're familiar with the IvyCamp. So IvyCamp is a part of IvyCap Ventures. And at IvyCamp, we focus on working, with earlier stage startups. We connect them to corporates. We work with a lot of the alumni, run a lot of workshops, sessions. So one of the things we hear most commonly is, for founders to connect with some other founders. So, Advaith is here. He's the founder of Wagr, one of our portfolio companies. And we focus these typically on specific topics that people ask for. One interesting topic that comes up again and again, and I haven't seen a lot on it, is, there are a lot of stories of startup success stories, but not enough about why startups fail, why founders fail. So we figured we have one of our founders here come and talk about, why startups are failing. Both from a generic perspective, but also Advaith will provide a little bit of his own personal story. So this one we wanted to kind of focus on that, and the idea is it's a small group. Feel free to ask questions. Make it interactive, because the whole idea is for you to get value, and Advaith is here this time to kind of also share his own experience. So then I'll just turn it over to you to get started.
Thanks, Sanju. Let me just stand here. Huh? Or here? Can they see from?
Yeah, the voice is loud.
Okay. Cool. So, thanks for having me. Okay. So, my name is Advaith. I am the co-founder of Wagr. It's a pet care company where we're building a personalized experience, a personalized companion app for pet parents, where we are providing online vet consultations, a marketplace of pet products, including our own, as well as guided content and advice for pet parents. So primarily in the pet care space. Before I go ahead, I just want to understand you guys better. We've spoken, so you are a first-time founder, I would say, right? Okay. What about you?
I'm Suresh.
Okay.
I'm a PhD developer currently freelancing. So at this meetup, I'll take
Sure. Do you have an idea in mind? Are you working on something? Or you're just interested in the space and you're looking to get perspectives?
I couldn't find the niche where I can start.
Okay.
I'm still in transition stage.
Sure. So you have the intent and you're trying to figure out what you want to do. Perfect. Great. And I'm sure a lot of people are joined in various stages. Either they're working on something on their own, or they already have an idea and trying to figure out what is the right thing to build, etc. So hopefully you'll all get some takeaways from my journey in this as well. So I'll just speak a little bit about my journey. We actually started out in 2016, 3 co-founders, me, Ajit and Siddharth, building at that time a hardware product, which was basically India's first GPS and fitness tracker for pets. We made a lot of mistakes. We pretty much failed in that one particular venture, honestly, I would say. We took 3.5 years to actually build out that product. We learned the hard way that hardware is hard. We managed to somehow get the product out to market. We raised 70K at that point from Qualcomm, and actually got it to market. Most consumer hardware companies take at least $1 million to get it, so we were pretty frugal, didn't take salaries for 3 years, just hustled it out, build it out into the market. But then, it's not just the product, there's a lot of larger forces which we'll talk about, which caused that particular venture to not succeed. In 2020, we launched it in Consumer Electronics Show, Las Vegas. We thought we could scale it, but COVID was one of the reasons why we couldn't fundraise beyond that point. Suppliers, manufacturing, minimum order quantities became much higher. We had a co-founder realizing that this is too much pain that he can handle. He spent 3 years already. His second kid is on his way. So a hardware co-founder had to leave. We were pretty much running out of money, and at that point we decided, me and Siddharth, my current co-founder, decided, okay, we need to do something else. So we pivoted. We still believe in the pet care market, so we pivoted to the larger market. We've focused on building what is now our core business, which is an online veterinary consultation service, along with parts of e-commerce. This was in 2021, and April 22 is when we raised from IvyCap, Inflection Point Ventures, and a few others as well.
So if I could, how did you pivot? Like a lot of startups founders say, they pivot.
Yeah.
But how do you know when, and like when obviously because you realized it wasn't going anywhere, but
Yeah.
to pivot to that, like what were some of the thought points?
Yeah, I think two main considerations is it. One is, okay, you're already on a path and you raise some money and you raise money for a specific thing, right? And your investors have believed in you for a specific market. Now, and this is a conversation to be had with your investors. When you pivot, like you pivot to a completely new thing, right? Which most of them might not be for, because some people invest based on markets, right? And that is your equation with your investors. And that second is, and I would say equally important, is your conviction in what market you want to be, what space you want to be, what idea you want to pursue. And for us personally, we were and are still believers in the larger pet care market, and even with the tracker, our ultimate end goal was to essentially be what we are right now, which is to be more of a personalized companion app for pet parents. So we believed in that vision, and we saw that the first step we could take with the resources we had was that particular direction of building online consults. So again, a bit of a personal choice, a bit of a conversation with investors, and a bit of what we feel the larger market requires, right? And at any point, and pivot is essentially you're building something new again. So at any point, these things I'm going to talk about later are applicable, in terms of assessing the market accurately, understanding the user's behavior, understanding the customer's need, and whether that need is valuable enough to actually build a business around. So there's a lot of considerations at each point, but I think these are the two main ones for us. What were the investors' comfort and what they were okay with, what we believed in doing as well. And I think this answer will vary for a lot of people, but for us this was. Right. So yeah, and I think the last 2 years we've grown, we learned a lot, we made a lot of mistakes again. I think at different stages in a company's growth, the types of mistakes you make vary, and there's of course mitigations for all of these, but usually you will find that there are different scenarios you encounter which require a lot of different learnings. And today I wanted to take you through all these mistakes and talk about mitigations for pretty much all of them, which I feel are important, and hopefully you will find value in that as well. So now, I think the first thing to really think about is what does it mean to fail as a company, right? And it's a very basic question, and there's just three answers. First one is you basically run out of money, what we call insolvency, and mostly happens because either you're unable or unwilling to raise additional capital, or the business is not profitable, and whether it's debt or equity, you're just not able to raise additional capital. So you just run out of money and that's it, the company's done. Right. The second one, this is slightly more rare, but definitely happens, where you decide to shut down. You still have money in the bank, but there is some conviction that you build that, okay, this market or the product or yourself as a founder is not working out. Now, it's slightly more rare, and I've known people who raised $50 million and within a month decided to return the money because they decided, okay, the conviction is not there, right? Which takes a lot of conviction, and I really respect them for it as well. But this also can happen, where you just decide it's not working out. Either something's happened in your personal life, or your founders have disagreements, but this is also a mode of failure. And the third one is I would say it's a partial failure, where you get an exit, either company acquires you or acquires you more for you as a founder or set of founders or your team rather than the product or the business that you build, which usually means that you are not returning as much of the initial investment, right? So this is also, from an external perspective, from an investor's perspective, definitely counts as a failure. So either you run out of money, or you decide to shut it down, or you get a less than optimal exit. From my experience, these have been the usual failure modes. Before we get deep into this topic, I just wanted to touch upon two broad types of companies. Now, there's many variations of these two companies I'm going to talk about. The first one is you decide to build from day one a bootstrap, profitable, sustainable business, right? Which a lot of companies have done, and there's no right or wrong in which direction you choose. It's about what you believe is the right thing to build. And the good thing with these companies is there's a lot more control on how you want to grow, at what pace you want to grow. It's more revenue driven, more like traditional businesses. At the same time, there is the trade-off that you don't grow as fast as you could. Your customer acquisition is very dependent on your profit generation as well. So you need money to like funnel back into growth. So many famous examples. One which I personally really respect and admire, IvyCamp. It's the company is called 37 Sequence, I think, and they've been bootstrapped from day one, and I think they've crossed $1 billion valuation. I mean, at least in ARR as well. Zoho and Zerodha, of course, very famous Indian examples of this. The second broad type, the one which requires external funding, right? Which most, I think, startups in the Indian space or internationally follow. It's usually a high growth model. It needs capital to grow either the user base or revenue. And the general idea is that you try to get to scale faster, more than profit, at least in the early days. Usually it's a high risk, high reward sort of an approach, right? And it's not that these two companies are always like, some companies who are bootstrapped initially might decide later, okay, there is scope to grow, might take on venture capital or any form of additional capital and switch over to this mode as well. And VC scale companies can at some point realize, okay, we want to be profitable either in preparation for an IPO or to get acquired, right? So they can switch, but usually they require very different modes of thinking and how you go about building that business and how you go about raising funding and the way you build product as well. So I think at the start of your entrepreneurial journey, this is the very key decision that you want to take. What sort of company do I want to build? Right? I mean, Flipkart, Swiggy, Ola, you can take any example of startups there. Next one. Now, just a small note on choosing your path. I think this is 4 things. What is the market for this particular product or business that you have in mind? What does it look like? Is it ready for rapid expansion or is it more?
Are you taking questions?
Yeah, please.
Yeah, now you mentioned those 2 things.
Yeah.
Again, one of the things is VC, if you want VC funding, your business should be VC fundable.
Exactly.
Which means the tick marks required for VCs have to remain.
Exactly.
You have a smaller market and you can build a good business, but not a very large business.
Yeah.
That may have to go to number 1 route.
Exactly. That's definitely the first point. Is the business something which is VC fundable, or is it something which needs or which can only handle like a sustainable, profitable sort of an approach, right? Maybe not profitable, but at least like a slow growth kind of approach. Ideally, to be VC fundable, you would, and which we'll get into later, you need at least like scope for 100 million ARR in the current sort of a market scenario. Second is like, what is your vision? Like, how do you want to grow it? Do you want to like try to grow it as fast as possible, or do you want to take your time, have 100% of the equity, grow it your own way, be the one who calls the shots? But so you're sort of sacrificing scale over sort of growth at that point. Then how your risk tolerance, like how much risk do you want to take? How much of your equity of the company do you want to give up? Right? And am I okay with being financially volatile for a long period of time? Both these companies have this risk, but at different scales. And finally, do you have the network to actually, in the early days at least, be able to fundraise? Do you believe in yourself to go out and sell your vision so that people will invest in you, even though you're just at an idea stage or a very nascent traction stage, right? So I think these 4 points, if you really like think through and do a little bit of soul searching, you decide sort of what kind of company you want to build, whether it's a bootstrap sustainable business or more of a VC ready, VC scalable kind of a business. Just some very generic yarn at this point, just to touch upon the different pathways, path that a company can take through sort of that VC format. And I think most of the points I'm going to touch upon later are more focused on the second type of company, right? Each has its, all of them can apply to the more bootstrap company as well, but more for the VC scale companies as well. So essentially at every step, the expectations grow and are different, qualitatively and quantitatively different. So you just have to be prepared that you need to just level up, whether you're in a pre-seed or just cross a seed and or pre-series A, series A, all the way up to the ideal IPO or you get acquired, right? Now, I mean, these numbers vary. Like sometimes series A merges into series B, or it's very mixed. But I think the number 1 thing to understand is in the early stage, when you are in a pre-seed or seed stage, the problems you're trying to solve are very different, right? And they need a different approach. And your failure modes at that stage are also very different. There you're trying to validate the market, whether you are the right person for that market, what the customer's actual need is, and to actually generate unique insights into that market, which will help you build a sustainable growth model, right? And you're essentially trying to show that there is a market, it's large enough, you're the right person to build it, and what you are gonna build is the right thing to build, and finally you can actually grow it in a sustainable way without burning out and dying or running out of money, right? And once you've proven that, you get to a series A or series. If you're in a series round, it usually means that there is a market. There is you have some form of a growth model which is convincing to investors at least. And from there onwards, it's a different game. It's about really building the system which grows. It's not just pure growth. It's about scaling the organization to actually be able to grow, to scale vertically, horizontally. I mean, different directions you can take. And the problems there are more about decisions, the right way to scale. It's about leadership. It's about scaling the culture. Very different set of problems. And today, I think I'll focus a lot more on the pre-seed, seed stage. That's what I've been more experienced with. And the failure rate there is also much higher. Like most companies usually fail once they've raised some amount of capital, either from friends or family, or from angels, or from their first institutional investor at a seed stage. That step up to a series stage usually is a very high bar. Once you cross that, usually means the market at least is there. You know, you crack that, and then it's more solvable problems, because for one, you know, you'll have like major investors who are the money is invested in you. You know, they'll try their best to make sure that you get the right advice, the right support to actually scale it to at the next level as well. And also, you know, these are problems like good advice, good boardroom advice, the right strategy, and good hiring practices. You essentially find the right set of people to build it for you. Whereas at this stage, it's about whether the problem even exists. Is it big enough? Is it valuable enough? Can you grow it, right? So very different problems to solve, and failure rate also is.
So are these generic, or do you see something different in India or outside? Just curious.
Honestly, I have only sort of secondary experience of the outside market, but I feel and again, depending on where the market is in terms of whether we are in a slow recession or more in a upcycle, the kind of willingness to put bets for investors is very different, right, in different markets as well. And especially right now in India, I think there's a lot more focus on, is the business eventually sustainable? That profitability thing comes in. Sometimes that flips, and then it's like more wild bets, more speculation, more gambling takes place, right? So I feel that is a difference in different markets, and also at different times. So it's tough to predict. Okay, next one.
So I think what I really saw in the beginning is really the validation of the pain, the size, and the opportunity.
Exactly.
And once you cross that, then of course the execution.
Yeah. I think initially, especially if you're a first-time founder or a young founder, it's more market risk, right? You're trying to solve market risk, and as you get more experience and the company matures, you're trying to solve execution risk, which has more sort of playbooks out there, Whereas market risk and your initial risk it's tough. It's more ambiguous, more confusing.
There's no playbook. You have to figure things out.
You have to figure things out. Yeah. So exactly. So at this point, usually you see these kind of things. Either you realize, okay, the market is not large enough, right? Or you haven't understood the customer well enough. So you're building the wrong things.
Luck.
No, I honestly believe luck plays a major factor at this stage.
Timing you can also add.
Yeah. And I think the next slide. Timing is also very key. You can be too early, you can be too late, right? Too early is, I've seen it a lot. I've personally experienced something like that as well. I think mostly at this stage, the traction, it ultimately culminates in traction. You have money, you probably burnt it, and there's not enough traction to actually convince someone to take the next step, right? All of it sort of culminates in that. And the luck part, I do believe it. Personally, our first investor, when we had the hardware company, came about because we attended an event which we did not plan on doing. I just woke up that day and I'm like, okay, fine, I'll just push myself, I'll go for it, I'll meet people today. And then it happened, so it was pure luck. So again, that factor does play a role at this stage, but later it becomes less of a role.
Yeah, but luck also in the sense that some founders, for any reason, are able to raise more capital.
Yeah.
You have more capital, you have more leeway to experiment and figure things out.
Yeah.
So even you have less capital, you don't have that leeway to do that.
Exactly, and I think the best way to put it is you put yourself in a position to receive the luck. You have to be prepared both with your product, your market, your pitch, everything so when luck presents itself to you, you are there to receive it. So yeah, show up basically. And this is the stage. Honestly, personally, we are experiencing problems in this stage. The last year and a half, we've learned the hard way that these are the main things which really can make or break you at this stage, right? And sometimes it takes 2-3 tries to actually get it right. So hopefully we'll get it right. We'll see. But product market fit is a very, very important thing at this stage where you are trying to figure out does it satisfy the market in a way that it can scale to a $100 million ARR business, right? Growth, you have to show growth in a sustainable manner. Ideally, don't focus it too much on like performance marketing. Of course, that can help you grow, but what you're trying to show is do you have like proprietary growth channels, distribution channels. We get into it a bit later as well. But some way that you're showing growth in a sustainable manner. Don't burn your cash flow out too fast. Like give yourself time to fundraise, actually grow the business in a sustainable manner. What happened with us, I think we, in the pet care business that we are in, we raised a certain amount and we decided to go a certain path which required a lot more capital burn. So we burnt a lot, and then the market turned and we realized, okay, we need a lot more money to fundraise. So then you're like essentially cutting your revenue down because in the quest for immediate growth, you are focusing on more unsustainable marketing channels, right? So try not to like go to zero as fast as possible. And this comes down to like conversations we have with investors. Finally,
what you're trying to say is try not to die.
Ultimately, the point is try not to die. Survive. Finally, this will be the first time you're growing from a very small team. Everyone knows each other, talking to each other, to like building systems of growth, both culturally as well as from a product perspective, marketing perspective. So this is where I've experienced issues where again can result in a failure mode as well.
So I think really a portion of what you just said, is figure out ways to cover your burn. Right? Try not to die means figure out ways that if you have a minimum burn, you have enough ways to cover that burn, and thereafter you can sort of experiment.
Yeah, and I would say again, I think there's a lot of mitigation you can do. It comes down to really talking to people at this stage who have gone that path, because a lot of people have gone this path, right? And I think that getting the right advice at the right time because sometimes you might have to burn to actually reach the numbers which you believe will get you to the next fundraise, right? A Series A or pre-Series A or whatever, right? But then that might not be the right decision. So it's a little more it's less ambiguous in the pre-seed stage, but it's still, I feel, way more ambiguous at this stage as well. But yeah.
So the fourth point,
Sorry.
team and the execution now, where we have the structure is not that we have right now we are small, so structure is not there.
Got it.
So to go towards the structure, what to do next? How can we successfully plan?
I think this answer is very different for every company and for every founder as well. But at this stage, there are usually playbooks, and by playbooks I mean people who have gone the path. And I think the advisor part, we were just speaking about it, right, is a very, very big thing, and it's one of the key parts of the next section as well. You need to find people who will help you, talk to you, understand your unique situation, your unique problem, and help you like set it up in a way. And I think usually, and this is advice I've read from Paul Graham's blog, which is that usually your culture needs to change at multiples of 3 and 10. What you need at 3 people, different from 10 people, different from 30 people, different from 100 people. So usually what happens is when you are growing, you miss out on recreating the process systems you need at these stages. And if you're very large, suppose that at 10K, your tendency is to like tinker more. Like, oh, why are we still? We need to tinker more. But you shouldn't. Like, you should let that be till at least like 30K. So at the stage you're in, I think focus on how many people you have. See if it's actually needed. Is it? You should only change it if it's not working. Don't change it just because you feel like it should change. And again, I think the best advice I can give you is to actually get people who have gone from that stage, like 3 to 100, right? You don't need people who have gone from 100 to 1,000 right now. You would need it, but go look at the people who have gone from 3 to not the next step, but at the next step after that, and then see what those learnings were and try to incorporate it, and make sure they understand your situation as well. Right? So having a personal mentor or a personal advisor is probably the best thing at this stage. And there's, of course, there's a ton of literature, but then from my personal experience, you have to tinker around a lot with people and systems to get what is working for you, and your team. I mean, I won't go too much into this, but basically, Series A onwards, it's a lot more. Is it the right strategy? Is the culture and team scaling in the right way? Is it scaling in the right speed? Are there operational bottlenecks that you're not solving? Right? And honestly, I've not gone through that path, so I don't think I'll be able to comment too much on it. And this is like second-hand knowledge. But from whatever I read, this is basically the failure modes from this point onwards. Again, from here onwards, competition, regulatory issues, a lot of things which can fail. But usually what I've seen is that at each stage, you need to level yourself up, right? And hopefully the things I'm going to talk about beyond this will leave a right foundation, right? So that it sets you up in the right way for all these challenges, which you will eventually face. At each stage, you'll have to face.
So one question I've got, one thing I've been hearing about for early stage companies failure is lack of governance, lack of compliance. I didn't see that there. Is that like a
So if you just go back, no? So yeah, I think just one more. Yeah, I think.
But you say it comes at a later stage.
It will hit you at a later stage, but you ideally should be thinking about it early as well. But it's like a lag indicator, and I think this is more true of specific industries.
Okay.
Like if you're in a fintech versus pet care, I think it's very different. Again, it's on a case by case. But ultimately, you should be like, if you know your industry well, you should be thinking about it from day one. Yeah. One more. Yeah. These are, the usual failure modes. Timing, of course, is a big one. But ultimately, all of these end up in either your cash flow drying up or you deciding, okay, it's not worth it, and you close it, right? But just stats.
When you say competition, is it that you don't have a differentiated product?
Exactly.
By competition?
Exactly. Competition affects you in two ways. One, their product sort of restricts what you can build. Ultimately we all like to be building the right thing, but the truth is that what your competition builds also really affects, at least in a way that if you're trying to build some form of differentiator. Right? Second is purely in terms of what marketing channels that they allow you. If you have a much more well-founded, if you're more or less equal, then there's more parity. But if you're taking on incumbents in the space, etc., the marketing channels that the CAC in each channel will be determined by what the competition also does as well. And if there are people with deep pockets, they can push you out of certain channels. So you have to be really innovative. So again, it pushes the onus back on you to be very innovative with how you find and acquire your customer as well.
And when you say team, is that a combination of like lack of ability to get talent and lack of kind of the right people at the top, or?
Yeah, I think a combination of one, are you the right person to build it? Because sometimes that founder market fit, which I talk about, is not there, especially when you're having a difficult period. You feel that passion for the market will keep going. Second is, are you hiring the right people? And I think that happens a lot, especially when you're just scaling. You might have to go through like 4 or 5 different hiring cycles to find the right set of people. And if you don't do it fast enough, then it might be too late. Right?
So like how to know different founder market fit?
Yeah.
How do you are
I think that's a very personal question, honestly. And I don't know the right answer, and you will only know it when things are bad, You might feel the passion for a particular product or a market, and you will pursue it. And if the money is coming in, then great, like because everybody likes money, right? But then when it's not coming in and you feel like, okay, this is not working out, customers are not coming in, etc. At that point, do you feel like you believe in that market or that vision so strongly that you will just figure out a way, So usually you will know that when you experience it. The other way to think about it is, can you be like that charismatic presence of that company? Like if you are building a community for that company, right? Can you build thought leadership in that space? Can you go out and be the face of the company, right? So sometimes you will find like a founder is much more suited to a market. Like if you take, I think one example would be Ultraviolet, the automobile company, right? The founder is a motorbike enthusiast. He's worked in Ferrari as an automobile designer. So if you go to his Instagram, that's all. It's the company's only thing which is there. Like it's just bike photos and all of that, right? So he's passionate about it. I don't know if he'll stick through the dark times, but I think it's been 7 years. They literally did not have a product for 6 years. Right? They just launched a product now. So there's definitely that passion for that space which has come through, right? So yeah, I think two things: will you stick it out in the tough times? Second is, can you be the face? Can you be the thought leader for that company? And at least one person in the founding team, I feel, should be that person, if not the entire team. Yeah. Okay, so now there's many ways you can do this. There's many problems you can attack. These are the next few things I'm going to see are mostly from my personal experience, and I feel a lot of it, at least from my perspective, address foundational issues, more high leverage issues, and hopefully they will help you in your journey as well. And this for me was the number one, especially if you're going for that funding oriented, fast growth approach. You need to take the time, and this is advice to self as well, for anything in the future, just take the time to think through, is this market large enough, because you might be able to get to a certain stage, but to grow beyond that, this question will come up a lot. Is the market large enough? And initially you might not have enough data to justify, so I think you have to talk to enough smart people in the industry. You have to find as many of the reports out there as possible, go McKinsey BCG style on this, There's no problem with that at all. Like try to really size the market. Also factor in competition as well, because again, you shouldn't be taking on a large market when there's like an IBM or an Amazon also playing in it. So figure out if you can potentially, given enough fuel, get to $100 million ARR, which is roughly the number which most VCs are looking at. Can this company get there? Which, because if it's a tech company, usually means like $1 billion valuation. And in the VC model, when they're investing in a few companies which can get to that stage, and maybe only one or two will get a return, that outsized return matters. So it doesn't make sense to invest in any company who's not even getting to, the potential itself is not there. Right? So if you go down this route, this is something which you have to address very early. Again, founder market fit. Do you care enough about the market and the problem to stick it out? And can you take on a thought leadership role in this space? This again, this is probably the most given advice, but the one which is least taken. To understand the customers really well, talk to them. Personally also, it's sometimes we just don't want to get on that phone call with your customer, but you have to.
This is the biggest shift that happened to me. We went through the big accelerator, and a lot of the initial, there's a book called The Mom Test, and it's not what we think the Mom Test is. It's really go deeper and speaking to your users in an informed way to understand what's the real pain. So that's really shifted me. Now I speak a lot to my users casually to get the conviction that the real problem is large enough.
Yes.
So this to me is super fun.
And honestly, I'm like a very introverted person. Thankfully, my co-founder is much more out there. So I usually let him speak to the customers, but I've also been trying to just talk to people, But it's very important. And the problem with, even when you talk, sometimes you have the solution in your mind, so you're trying to get them to give you that answer, So you have to somehow make sure your conversation with his interview surveys.
So there's this guy who he explained they spent 2 years in developing a product, and then they realized it's not solving a real problem.
Yeah.
Then they really go back to the fundamentals and ask the questions in a non-leading way.
Yeah.
Because we all want them to say
what we want them to say.
What we want them to say, right? And that's really not it's just it's cheating, right?
Yeah.
But if you, with these conversations, ask them those open-ended questions, and they can share what their real pain is, that is a valuable comment. And we do it across many, maybe hundreds of users. That strengthens our conviction. It strengthens our conviction. Forget about anything else.
Yeah, and I think for your market conviction and conviction on what your user base needs, then you will have the conviction to follow through on what you.
So, Advaith, did you say this was one of the things when your first time you did not?
Yes, I mean we.
Like, what is the mistake?
We tried to get them to give us the answer we needed. We're like, do you want a tracker which will help you find your lost dog? Yes, obviously I want it, but will they pay this amount for it? Will they use it often? Those are questions we didn't.
Follow-up questions that are
Yeah.
that you did not.
Yeah, I would say. I mean, we spoke to like almost 300 folks, surveys, interviews, etc. But then, when you're just so set on doing this, when the idea has taken hold, and then you're like, okay, I want to build this, right? You might lose sight of, okay, is this the right thing to do? It's a very tough trap to get out of. And usually, you need to go through that pain a few times to build that mindset. And I think one model which I found which tries to get to that answer quickly is the jobs to be done framework. Which is I found it a very powerful framework. It was Chris Christensen, I forgot his name. Anyway, but very powerful framework to just understand the customer in the terms of not of personas, but in terms of their actual work. What are they trying to solve, and it also gives you insights into how their purchasing thought process happens from their first impulse of buying to eventually buying it. So if I had one recommendation in this space, is the jobs to be done framework. The other was I think since the 2000 onwards, as a sort of a counter reaction to the .com bust, the lean startup idea has taken hold. Now it has a lot of useful insights, being agile, being experimental, but I feel if you take a company like Apple or a company like even like a Zerodha, they wouldn't exist if they just started out as a lean startup. I feel it's better to be a deliberate startup, and that means talking to your consumers, understanding a few unique insights and building your strategy around that. So the problem with lean is your MVP or your minimum viable product might not, at least according to me, might not be good enough to accurately represent the solution you're offering. So the feedback you get might put you on the wrong path. Whereas what you should be doing is validating that insight, the insights that you're generating from the user base. And that's my personal opinion. Next one.
How many number of feedbacks you had to develop something? More like this market feedback.
Sure. I think the market fit question is slightly different. That is related to your product. When you're trying to understand the problem, usually you should at least speak directly to 50 people, mix of quantitative and qualitative, and also at least do a survey and use, if you have the money, go for a market research agency, good one. If you don't, get someone to help you formulate that survey in an as unbiased manner as possible, and send it out to as many, definitely above 100. If you can get it to all the way to 500, I think there's a lot of conviction that you can take. But if you are starting out with some capital, hiring a good market research agency might be the right thing to do. But yeah, talk to as many people, form your initial insights, use that to form a survey, be as unbiased as possible, send it out, and then analyze it.
So initially talk to one-to-one.
Yeah.
And then after you create some forms and people do survey and send it to.
But I think each step there is a sort of a good way to do it. When it's your first conversation, first 10 conversations can be more free-flowing. You're just trying to understand their mindset, etc. And once you have some insights from that, you can then organize your next interviews in a more structured, so you know what questions you're asking, so you get more repeatable patterns. And then you want to scale that, so you create a form which you scale to as many people as possible. But I think taking the bias out of this process is the most important thing, right? Whether it's in your conversations or with the surveys, right? So it's tough for a non-market research professional to do well. Nowadays, I think tools like GPT and all can help you greatly with that. But my personal advice would be to at least consult with a research professional to see the standard methodologies which they follow.
Again, my recommendation, which has really helped me, is to read this book, The Mock Test. And the guy explains how people lie to you. Because you ask them questions, they want to be nice to you.
Yeah.
So they keep saying things that you want to hear. And so you have to ask the questions so that you uncover that.
Exactly.
And then he also makes a nice observation. People stop lying once you ask them for money.
Yeah. I mean, people will say they buy a product, but when you ask them to open the wallet, no, that's when you know the truth. Yeah, and I think this is a no-brainer. It's not just finding the right advisors. You should be able to trust them and also be able to take their advice. You know, as long as it makes sense. Like you should try to get perspectives, different perspectives, try to balance it, and do it. You know, and you know, in my journey, I've had a lot of advice from a lot of good people. The ones I haven't taken, I've definitely regretted, and the ones I've taken, some small regrets, but usually never gone wrong. If it's somebody who knows the space well, who's done it before, who's somebody who has your best interest in their heart, right? So ideally, I find that finding mentors is just a win-win. You have the right mentor. You can have.
So that's the issue, right?
Yeah.
One thing I hear is how do you find
It is very tough.
the right.
It is very tough.
What would you advise? Like, how do you go about finding? You know?
See, the standard advice is usually the mentors you want are also very busy people.
Yeah.
Yeah.
So you have to give them value as well. It's a little bit of a personal thing where you go meet them, you give them value, you build a relationship, and it should be somebody you can just pick up the phone and ultimately just dial and talk to them through different problems. At least have like a weekly or a bi-weekly catch-up. It could be a family friend, it could be a friend's parent or relative. You know, usually I've seen like right now we have a marketing mentor who's my co-founder's uncle, you know, and that works well because there's that personal connect there. But honestly, I feel there's no right answer. I have also had taken a coach last year because you know there are certain parts of myself I wanted to improve, but I feel that works when you know what you want to improve, right? When you know that, okay, this is something I want to do, I'm willing to spend money to improve that part of myself. Coaches also help in specific aspects, but because the monetary aspect is there, it is tough to, you know, you will feel wrong or bad calling them up for every single thing. Unless you build that relationship through that coaching process. That also can happen, right? But I think the best way to think about it is, what do I need help in? Is it my business? Is it the product? Is it the marketing? Is it a mix of all three? Look at those in your space ideally who have gone through that path before. Again, the rule of 2 steps above. You don't want someone who's like an IPO level at this point. You want someone who's, if you're at a seed stage, maybe he's at a Series B stage, right? And then essentially try to build that relation. That is completely up to you. You have to go and figure out what help they need, give them that value, and build that relationship. Right? So, but this is probably the highest leverage thing you can do on a personal level, right? Whether it's this company or something else you build, I think it definitely adds a lot of value. Okay, this I think I'm much more of a product person, but I realized that most good founders are as fanatical about distribution and growth as about product, and you have to think about distribution and growth from day one. Like, and if you build it, most likely they will not come. Nobody will come. You have to.
They will learn that painful way after your first couple of startups.
Yeah.
Then you start thinking of the selling and the distribution right from the thinking.
Yeah, it has to be probably the first thing once you lock onto the idea, right? And I think another mistake in this specific aspect you can make is to focus only on like performance marketing, because that's it's low-hanging fruit. You spend money, you get customers, but there's always a saturation point with performance marketing because every other company in that space will just come there, right? So, and this is very difficult to do, but you have to think of proprietary growth channels. Like, I think, I don't know if you guys follow this company called Main Street. That's one company I've been following a lot. They're essentially like a culture company, and they've just owned that space in terms of YouTube videos, Instagram videos about sneakers, high-end jackets, etc. Right? And that content and community play has created a proprietary channel. Now, when they want to sell it, they have this massive network of 1 million followers or 1 million YouTube subscribers to get back. Now, usually, and just to get a little more in-depth into this, in terms of sustainability and beyond performance marketing, there's 4 main channels right now which can work. One is Google SEO or any Bing SEO, right? So that is still in play, even though GPT and all are taking the market share. The other is GPT itself, and I think you'll slowly start seeing that as a viable mode of acquisition. People are now slowly not searching on Google, but they're searching directly on, and eventually they'll want to monetize that aspect also. So just keep an eye out on that. Third is, of course, your organic content channels, which scales based on the quality of your content, which is Instagram. Instagram, not so much. There's just organic is dead right now. Like, it's tough to scale without putting money in. YouTube still is there. TikTok, unfortunately, is not in India, but TikTok outside is really working well in terms. Like you can put out a stupid video and still go viral, which you can't do out in Instagram at this point, right? So, and the other is your own community, whether it's on your own website. You find your tribe and you lock them in, whether through an app or a service, right? But yeah, I think the core idea is that you find your tribe and you collect them in one place, right? And then you monetize them for your eventual revenue channels, etc. But depending just on Facebook or Google at this stage will create a big bottleneck when you want to take that jump from maybe a seed to a Series A. People want to see locked-in audiences, which eventually reduce your CAC as well. And just one other point. The other is thinking of product and growth together. Like they have to be so locked in. Like your growth team and your product team should be just one team. You can call it whatever you want, but and there it's all about growth loops, especially for digital products, right? You have your acquisition loop, which is maybe getting somebody to the Play Store and then they're downloading it, and that person is also amplifying whatever it might be, like a reshare or a referral, right? And then I'll talk about it in the next one. The most important thing is retention. Once you acquire them, you want to retain them, because if your retention is poor, then you're just putting money into a growth engine which is just always going to lose money. So yeah, next slide. So this is something, again, I've learned the hard way, which is retention is the foundation of growth. Right? If you have good retention, then more user acquisition, better monetization, your CAC is better, your LTV payback, which means if you spend 1,000 rupees to acquire a person, if you're a guy with poor retention, might take a year to reacquire that 1,000 rupees, whereas someone who has better retention might take 6 months, right? Which means that extra time you can actually spend on reacquiring more new users. So, and this also gives you a fairly reliable indicator of product market fit. What you want, and I'll talk about it in the next slide, which what you want to see is like a retention graph which goes flat, right? If it's declining, that means eventually people are going to stop using the product. So your LTV is pretty much going to be very poor. And ideally, even if you build a growth engine, you shouldn't put like more fuel to it or money to it till you solve retention. Ideally, unless you are desperately like wanting to fundraise and you want to show top of the funnel metrics, right?
From a B2B perspective, we make sure the integrations are there and all those bells and whistles are there, so that it's easy for them to adopt and it easily fits into the system. From a B2B perspective, that's a key to retention.
Yeah, and I think more locked in usage. You want them to just be so locked in with your product, right? That it's tough for them to.
Yeah. So for example, if it sits into their system, if it sort of whatever integrates, if it seamless log on, whatever it is.
Makes sense. Yeah, I mean, simple example would be like a Notion, like a non-physical example. The more you put your notes into a Notion, right, you're more locked in. You're not going to leave Notion after a point, right? And I think on that note, one key point, you can actually, I think if there's one thing you guys should go back and study well is, different aspects of retention, both from a physical product perspective, digital perspective. But the right retention metric is also very key. Like if you're building a SaaS product, you could be tempted to calculate retention on revenue, but I feel like usage might be better, because somebody who's taken an annual subscription, right, you're not going to see that he's going to not repay after 6 months. But if you check his usage patterns, you'll know, okay, he's actually not working out. So this again, ideally a good advisor will help you. If you want to find a good product person to really think through your retention, how you're going to engineer retention in your product, right? What the right metric should be, and the most important thing is the natural frequency of the retention. Like if you have a social media app, you want to be tracking your retention on a daily basis. Whereas if you are an urban company, a monthly basis makes more sense. So, and usually retention is much more correlated with the need that the parent has. Sorry, I'm trying. Need that the user has. I'm just so used to saying it. Need that the user has, and how your product solves it. I find that usually adding small features to your product doesn't really improve retention that way too much. You need to really solve the core problem well to crack retention, at least for a certain set of that audience, and also crack that natural frequency, understand that frequency. Yeah, next one. Just a graph. What you want to be tracking. I mean, this is for me has been a very. It makes sense how to track product market fit using retention. So each cohort you should be tracking your retention curve over time, and this shows that okay, this retention is going to eventually fall to 0. Whereas these two, it gives you two things to work on now, right? This means that you find either of these two. Ideally, the green one is better, but both give you two things. One is you have a locked-in audience who's finding value. So you have a PMF, product market fit, with that audience, right? Now you can work on two things. How do I find more of those people? What are they finding value in that, right? And essentially try to grow this, right? Try to improve the product for them, find more of such people, profile them, target your growth channels to that audience. And the most important question to ask is, does this audience by itself get you to 100 million? Right? Is this getting you to that TAM, right? If it doesn't, then you have to ask the second question: how do we get these guys? Right? What is missing? In a way that you don't alienate, unless you find like a group of people who are bigger than this, right? And that's up to you. But it gives you like two directions to work with, right? If you have a flat retention curve, right? In the early days, I think trying to get to this would give you those metrics to really focus and improve on. This is also something I've recently learned, which is to, from day one, at least think through your exit strategy. You know? Ideally, we all want to IPO, but most companies who have some form of success usually at least get acquired, right? So it's okay to actually be upfront about it. Sometimes investors have an issue with it, but eventually they also make money when your company either IPOs or gets acquired, or you are profitable. I mean, profitable means you end up doing an IPO. So you have to be a little thoughtful about your acquisition strategy, who can eventually acquire you. And usually, whether it's a relationship with an investor or a potential acquirer, it's never a point. It's a line. It's a set of points. So if you can build relationships from day one, understand how you can add value to them, at least you are able to factor it in your product building process or your business building process. Right? I'm not saying build to be acquired, but build keeping in mind that this is something which is important. Yeah. Okay, one big mistake we made initially was not have a CEO. The three founders with very strong, opinions on things, and weirdly enough, consensus thinking as well. So both we'd fight and then we'd take the consensus decision, which was 2x worse. So I think since then we have corrected that, and it's important to have a clear decision-making structure. Even if you don't have a CEO, at least make sure that it is important to know that how the decision gets made, and try your best to foster disagreement. I'm not saying be, I don't want to say the A word, but don't be a bad person. but have disagreements with, like, don't take the consensus decision basically, right? But ideally have someone who.
Say it again. Say don't take the consensus decision. Can you explain that?
Yeah, I mean, usually what happens is if you are like 3-4 people and each of us has, or each of you have the same decision-making power, right? Usually what happens is all of us will try to get to what is agreeable for all.
Okay, I get it. So don't try to make things agreeable.
Yeah.
Take the right decision.
Take the right decision, yeah. And usually works when you have one person where the buck stops. It might be the wrong decision, but at least you'll find out faster. You don't waste time in talking about it and not deciding, right? And in the early stage, you have to bias more towards speed, right? Later, of course, this becomes the most important thing. The decisions you make is the most important thing. But in the early stage, you can still run a little bit faster. You're okay with slightly bad decisions. I think the impact of the decision and the information you need to make that decision should correlate. If it's low impact ones, you just take it and move forward. High impact means you take some time.
So that's the other learning we have is honestly the only thing we can do as founders is speed.
Yeah.
Whatever it is, just move very speedily and take risks and take calculated risks and take decisions with insufficient information.
Yeah. I mean, you'll never have perfect information. A lot of it comes from experience, intuition, etc. And
What is that discount? The biggest
I think this is a line I copied from Jeff Bezos. He had this policy where you can have disagreements, but if you've taken the decision, commit to it. Like okay, suppose we have a decision on you say this is the thing to be built, I say no, this you have to build, but you're taking the decision, you're the CEO, and I'm like, okay, fine, I disagree completely, but I'll commit with my whole heart to build this, right? And then we'll see if it works, it works. And of course, you factor it in when you later have a conversation like, bro, you're completely wrong. So I want to be CEO. Right? That's a separate conversation. But when that structure is in place, you just move forward. Right? Don't fight and be in limbo. Is what I would say at that early stage at least. So next one. Yeah, this I think is fairly straight. We just have to adapt. At early stage, you just have to do what it takes to survive. And by survive means not go to zero in your bank account. And also, I think you have to be a little flexible with your vision. Like you might start out thinking, okay, I want to build this, right? But then you realize as you talk more to people, as your product hits the market, and then things evolve so much, right? Be true to, I think, values, but you should be able to adapt to markets and customers' needs, right? Don't be tied to that specific thing you want to build. Your identity shouldn't be that. Next one. I think this is probably the last slide, and this is something which I feel very strongly about. You have to take care of yourself. This is a very hard, sometimes lonely journey. For me personally, exercise and meditation meditation especially has been very life-changing. And I think the specific way it does is like building a company it's like being an artist. You are creating something of yourself, putting out there for everyone to judge, like employees, customers, your family, your friends, your investors.